All right. Good morning. Little pre-market video. Day late. I had some time, thought I'd run through another lesson. So what we're looking at here is MarketWatch, marketwatch.com. It's a free website. It has tons of information and ads and things. I use it particularly just to look at option chains. So you go to marketwatch.com. Don't sign up for anything. In this upper right here, you pick your stock. So for today, we're just going to look at open. So Open Door Technologies, it's trading around $6. I talk about this one a lot. It's just an easy one to trade and an easy one to use as an example. So what you have is the company name, where it's trading. This is pre-market. Um, just this graph is just showing you what the pre-market trades are. Here's 9:30. You go down here, you can see key data, things, financials. It'll go through, earnings and what analysts think of it. But I go over here, right there, where you see options. This now shows you the option chain, expiration of January 30th. Okay. So how you read this is strike price. So these are the strikes that will end at 4 o'clock on January 30th. Okay. They're all your strike prices. Here's the premium for it. Puts on one side, calls on the other. That's what you buy it for. Excuse me. That's what you sell it for. This is what you buy it for. You always buy it for more than you can sell it for. All right. So the first thing I want you to see is when it's close to being at the money, there'll be the most premiums. So this is out of the money because it has not reached this price yet. So there's a nice chunk of premium. It's 19 cents away, but you can sell it for 28. So if you wanted to purchase the stock, you could just go ahead and buy it. But if you wanted to sell the put and the stock stays below 6, you get paid to buy it, depending on where it goes. But you're assuming the same risk as if you bought it. You just, if it goes above 6, you don't have to own it. So what I wanted to show you is why it's so nice to sell puts, because time is on your side. So what that means is this premium is made up of the price action, the strike price, and the time. And then the delta is how much it'll go up and down as the price moves. So, for example, there's an inherent 19-cent value because of the difference in the price. So if this was 29, 19 of it is just the price difference. And then that other dime is your premium, your reward, if you will, for selling it. So what I want to show you here is this week, and this is why time is on your side. Exact same strike price. So this is 28 cents for the 6, and it's a nickel for the 5.50. Okay. We're going to scroll down here and look at February. It's not even a full week out, but that goes from a nickel to 13, and that pops up 10 cents. So do you see what I'm saying? Exact same strike price, just more time. So let's go out another week. Same strike price from a nickel to 22 cents. So what's the takeaway here? If you sell this and the stock just stays above your strike price, goes sideways, goes up and down, this is going to deteriorate over time. because the time value that's baked into this will erode because there's less time. Same strike price, 2 weeks away, Friday. Now, the time increases the risk. The stock could go to 250, could go to zero, but it could also rocket up here. So that's why charting and those things is so important. But the point is still the point. There's time baked into that. When you sell it, I sound like a broken record, but when you sell it, that time erodes, right? Tomorrow, there's automatically less time in here. So let's look at the chart and see why this strike price, this stock, this price point, and this put would be of or to your value. All right, so what we have here is Open Door Technologies. And I think what I'll do is I'm going to make a video just on TradingView on how to set it up. But right now, how you set it up is I went to indicators and you pick, well, you type in what you want, moving average. And you can get simple moving average. There's very different ones, but simple moving average, you click it, it appears. You can change your time frames. So just for this example, this is what I use. I have a moving average of 13, it's 13 days, moving average of 50, and the 200-day moving average. This black line is the 200-day moving average. Average price over the past 200 days. Pretty simple. The shorter the term, the more you can see the red way up and down because it's averaging the price over a shorter period of time. When it's above the red line, you're going up, you're buying. When it's below, you're going down. When it's jumping across, it's going sideways. But here we've been in a sell mode for a while. And you can see here, this is called moving average, MACD, moving average convergence and divergence. This is where it converges. As you can see, further apart is diverging. So these give you buy signals. So what I did is I put these little smiley faces, no idea why that one went upside down, but support line right here around 574, give or take, since September, Wednesday, September 10th, last year, 25, this stock has been bouncing off this for a while. These little smiley faces are entry points just based off price action. So if you look at the previous chart where we had strike prices, if you were to sell the 550 or the $6, every time you see one of these little smileys, you will have made money. So if you sold right here when it hits 570, if you sell the $6 for any time in the future, as this stock did all this up and down, the time value would erode. So to keep the math simple, if you sold it here for 25 cents, a week later, it's worth what? A nickel? A dime? Nothing? It either expires and you keep the 25 cents or you buy to close it. But let's just say you sold it for $1 and it was 6 months out. All this time to where today we looked at it, where we are here today, and the 550 was only worth a nickel. So hopefully you get my point. Time is on your side because it's eroding the value versus when you buy it, if it does not participate in the way you want it to participate, time is your enemy because it's expiring. So that's why selling puts is so strong. Now, in this example, Sell a put, goes up, buy it to close. Sell the put somewhere in here, it goes up, buy it to close. Here, a little risky. Opened way down here. Sell the put, goes up, expires. Sell the put, expires. Now, a lot of times, obviously, you don't know what the future is. You're looking here, you're thinking, oh, it's going way back up. You start selling puts in here, and that's when you end up owning it. We'll talk about that later. But just based off the charting, you could sell puts on all these bottoms, even more than the smiley faces, and you would be profitable on this stock every single trade. So if you're doing this on paper and you go back to uh, say Monday, January 26th, and you sold the 550 put just on paper, whatever you sell it for, you can track and see what it does in the future. Because if you're listening to this in a future date, you'll have all that information. But that's a good way to use this as a paper trade example, is to see what it did on these dates, because this is pushing down. It's trending down, risky trade because it's right at the money, but converging trend lines. But typically over the past, whatever that would be, since September, all these smiley faces would be profitable trades.